Each of our four types of traders will use one or more of these common strategies to profit. First, we have arbitrage. And arbitrage is when a trader takes advantages of mistakes in the marketplace. When prices of a particular stock are different in two different markets, the arbitrator buys the shares at the lower price in one market and sells them at the higher price in the other. Since these types of price mismatches don't last long and have been virtually eliminated thanks to high-frequency trading, this type of trading is almost all but dead. I still wanted to include it to let you know of a really popular trading technique that used to be used a lot. Next, we have momentum trading. And this method of trading is done with a particular stock that is exhibiting a specific trend. Now remember, trends, we're looking at short-term stuff here. So the trader follows the trend by placing multiple trades until the trend ceases or reverses. If the trend of a share is moving upward, the trader will buy the stock and then sell it when the price has appreciated by a predetermined amount. And so this means when the trader goes in, they say, I'm going to be in the trend for 50 cents or 8% or $1. So they have, when you go into the trade, you know exactly where you're going to cut out. If the stock's price is falling, the momentum trader will sell the stock first and then buy it back again as the downtrend continues. And this is known as shorting. So let's jump into shorting really quick so you can see one of the trader's best friends, because this allows traders to make money when a stock price is going up and when a stock price is going down. Many brokers allow you to quote-unquote short a stock so that you can profit from a drop in a stock's price in the same fashion you'd profit from a rise in the stock's price. When a trader shorts a stock, they borrow stock from the brokerage, and then they sell it on the open markets as if it were their own. If the price drops, the trader will buy back the same number of shares on the open market at the lower price and then return them to the broker that they borrowed them from. The profit is the difference between the initial sale price and the cost of buying the stock back. For example, let's say we want to short a company stock at the current stock price is $100. We borrow 100 shares from our broker and we sell them on the open market at $100. Let's say we hold the position for a week and the price drops to $75. Now we currently don't own any shares, so we have to buy back 100 shares in order to repay our broker. So we buy 100 shares on the open market at the new current market price of $75. Now at this point we still owe the broker 100 shares, so we fulfill that debt with the 100 shares we bought at $75. In this example, ignoring fees, we have made $25 a share, the difference between what we received initially selling the stock and how much we had to pay to repurchase the stock. Feel free to rewind that portion a little bit and go over it again. Shorting is quite complicated, but I can guarantee you, once you get it, it is a great tool in your toolkit if you decide to become a trader. Next, we have pattern trading. Some traders believe stocks have definite patterns to their price movements. Pattern traders study these patterns and use them to trade when they believe a particular pattern is forming. So some common ones are the golden flag or the teacup or the double top. Essentially, I want you to think of it as think of the chart as a picture. The chart, a teacup looks a certain way. It looks like a smiley face. Like a long smiley face or half bowl, and then looks like it has a little handle. So what they do is they look at that, they have that picture or image of what an ideal price chart looks that has a teacup pattern, and then they look for other charts that look like they're going to look like the same thing and trade accordingly. Next, we have scalping. And this trading technique involves making several small trades very, very quickly. This type of trading only works when there is a difference between the bid and the ask prices. Think of it as arbitrage, but in this instance, the trader is doing it within the same market, often within seconds or minutes. the profits are extremely small and almost non-existent now thanks to high-frequency trading. And this is almost pretty much non-existent unless you're doing it with low-volume stocks that have very wide spreads, and that means there's a very wide difference between what the sellers are trying to sell for and the buyers are trying to buy at. So very tricky, very advanced, hardly used anymore. Next, we have price action trading. And this trading is one of the simpler types of trading in which traders only consider stock price movements such as open, high, low, and close within a predetermined time frame. And again, this is why we did time frames first, because we can use these strategies on different time frames. The period will vary depending on the trader. Whatever the trade period, the position is closed at the end of the period even if the trader didn't make any money. And this is simply looking, hey, if the stock opened at 30 and its previous high for the week was 32, if it breaks above 32, the price action trader will go in and buy at 32 because they want to take advantage of that action because they think it might go higher. On the other hand, they might see that it hit 32, which is its week high, and they say, you know what? This isn't going to go any higher because I know that's at 32 and it comes right back down. So they don't think it's going to break out and go higher, in which case they will short at 32. And that's why we covered shorting, because price action traders, they can go long, which means they'll buy at 32 because they think it's going to keep going up, or they'll short because it's hit 32, it hasn't gone above 32 before, so it's probably just going to fall back down. And this example is perfect to tie into earlier when we were talking about the glass half full versus half empty. Again, both decisions are based on the exact same information. We're just making a different conclusion from the information. Next, we have swing trading. And swing traders look for the beginning of a movement or swing in the price of a stock to initiate a position. The position gets closed when a definite indication that the swing has come to an end. This is very similar to how momentum traders operate when they are looking for an uptrend or a downtrend. In this case, the swing trader only uses two trades, one to enter and one to exit. In contrast, momentum traders will follow the movement of a stock, opening and closing trades as the trend continues. Swing traders tend to have a much longer time horizon than momentum traders, and that's why looking at our example above of the different time horizons, they're normally going to be short-term traders or medium-term traders because they're looking at chart trends or patterns over a couple of days, whereas the momentum traders are looking at intraday stuff, or meaning things during the day, and they're just trying to make a quick buck as it goes up. And then we have range trading. And when a trader believes that a stock is moving within a given range, they will trade with this range. Now, here's how it works. To buy at the lower level and then to sell at the higher level and vice versa. And this works when a stock is quote-unquote ranging. The trader will have studied historical price movements to identify support and resistance. So let's think back to our discussion of volatility and how we think of it as standard deviation. This concept is what range trading is based on. In our example, our median or stock price was 5 and the standard deviation was 2. This meant that the stock's price range was between 3 and 7 based on our standard deviation of 2. These two numbers, 3 and 7, make support and resistance respectively. So 3 is our support and 7 is our resistance. So the range trader buys around 3 and sells around 7 under the assumption that the stock price is going to continue to bounce back and forth between those two levels. Finally, we have trading news, which isn't really a real technique, but I wanted to include it because so many amateur traders use the news to make their trades. And it's one of the most common types. Unfortunately, it's just one of the most common types of trading techniques. I mean, it's not really, I don't think it's a technique, but so many people use it, I'm going to include it here with the techniques. Please don't use this one. This is so common that there are actually real trading techniques that work against this to just essentially take advantage of novice investors. Normally, news developments are only part of a complete trading plan. And for a multitude of issues and problems with trading the news, please refer back to a previous module where we talked about the challenges of trading with the news. I think we talked about that in module 2. So that completes briefly discussion of the types of traders and then the various trading techniques they use. So feel free to pause and rewind and look at the different ones. Some of these might stick out to you. Some of these may appeal. You'll find that the reason there are so many is because there's so many different types of people. And you'll find that some play to your personal strengths and some play to your personal weaknesses. It's about finding which one works for you, which one you like. They will all make you money. There's no which one's going to make me the most money. The one that's going to make you the most money is the one that best fits your personality and the way you think. All right. Now I want to get into investing. And this is buying companies, not stock. And this is what I really like doing. I do some medium-term trading, but investing is really my bread and butter. So I'm excited about this section. Investing is the act of purchasing company stock to profit from a company's performance, not the price movement in the company's stock. The majority of us will fall into this category. Because unlike trading, investors are primarily concerned with the underlying company the stock represents. In many instances, investors make investment decisions as if they were going to purchase the company as a whole, not just the stock. Under this mindset, the stock is simply a medium investors use to own part of a company. This methodology is based on the belief that the price of the stock doesn't actually reflect its value. So let's jump into price versus value really quick. Price is what you pay, and value is what it's worth. Traders operate on the assumption that a stock's price is always equal to its values. Investors operate under the assumption that the stock's price is independent of its true value, which provides opportunities to profit because they can buy companies whose stock prices are lower than their true value. A really simple way of thinking about this is Black Friday sales. We all know that some deals are really good on Black Friday, or maybe the day after Christmas or Boxing Day if you're in Canada. It's when that 54-inch TV that's normally $1,200 is now marked down to $700. It's $500 off. So you stand outside in the freezing cold, you're standing there all night so you can save your $500 and you get that awesome TV that you probably wouldn't have been able to afford anyway, or you just want to save $500 because who doesn't want to save $500? And then you get the TV. Now, because the price is temporarily at $700, I'm losing track of my numbers here. Because the price is temporarily at $700 does not mean that the TV is now worth $700. If the fair value of the TV is $1,200, like it's normally priced, then that is still its value. And the reason people go outside and they stand in the freezing cold is because they know they're getting a deal. They know that the TV is worth $1,200, but they're getting it for $700. If the TV was worth $700 and it was normally priced at $1,200, nobody would stand out in the cold. No one would buy it because it's overpriced. And so that's essentially what value investing comes down to. And that's the difference between price and value. And it looks like, I'm looking at my slides, I got a little ahead of myself. But I really want to hound home this point because this is how I've been able to consistently profit in the markets. And I want you to do the same. Is when we see that the price of a stock, I just want you to switch out the example really quick. Let's say it's company XYZ instead of a television. There's a way to know that company XYZ is worth $1,200 a share. And when the price drops to $700 a share, that is a $500 discount. It has gone on sale. The good news, you don't have to go standing out in the cold, or wait overnight to get your discounted stock. You can just go buy it immediately. But when you know that the TV is worth $1,200 and it's at $700, it's a good deal. It's a great deal, because just because the price has moved doesn't mean the value of the TV has changed. And that's the premise and the essence of what value investing is. Some of you may be asking, okay, well, that's great, but how do you know that a XYZ company is actually worth $1,200 a share? Well, it's just kind of the same way you know that the TV is actually worth $1,200 and you see it at $700 and you know it's on sale. You do some basic fundamental research. And I like using TVs because most of us don't just go to a random store and buy the first TV we see. We all know that some stores are going to charge you more for a TV than others, and sometimes we wait until it goes on sale. The exact same premise of getting that awesome 54-inch TV for $500 off is what we will use and apply when we talk about fundamental analysis and value investing in our next module, Module 4. All right, thank you for watching. I hope you found this informative and actionable. This concludes Module 3 of the Stock Market Foundations course. If you have any questions, please let me know in the comments section below. To jumpstart your trading and investing, I encourage you to head over to thewealthtitans.com and subscribe to my YouTube channel for more free investing insights and some great investing blueprints to really ramp up and make sure that you get started on the right path. You get started on the right step. Utilizing the best techniques we just discussed, I have a link to a PDF guide that outlines everything talked about in this module. So go ahead and leave your comments and questions below. Subscribe to the channel, and I'll see you in the next video. To your investment success.